Hey everyone, I'm here with Matt, who is one of the founders of Higher Than Average Growth, which is a data platform that I use all the time to analyze data to pick those boom suburbs. So if you are looking to pick a boom suburb, listen up. This is going to be an eye-opener for you. So thanks so much for jumping on, Matt.
Thank you for inviting me, Adam. It's a pleasure. Appreciate it.
Awesome. So Higher Than Average Growth has been running for 7 years. Matt's just told me he spent 2 years, or 2 years, 2 decades in data analysis and has a PhD. So he's a doctor, but not of medicine. So he's a really smart guy. And I selected using this platform, the Higher Than Average Growth platform, after analyzing various different ones because I saw that it was honestly the best and it produced the data that I was looking for. And this analyzing suburbs and looking at the data sets and numbers, there's various different platforms that do it. And they spit out different sources, different numbers. And when you're looking at 10 different sets of data, you actually don't know which one to believe. So after looking at their algorithms, the data that's being produced, and the results over some time, I decided to go with Matt's platform. So Matt's going to give us a rundown on how it works, how you can pick booming suburbs, and how all that stuff, how you can
Thanks,
make money
Adam.
from
Thanks.
property.
Thank you for the kind words. Honestly, man, I know you've been, our subscriber and using the platform for a while. And I usually see your videos online and how to use it. You actually, as I always say, there's one thing to have figures on a page and yet another to connect them into a story. And you do that extremely well. So that's what I want to actually showcase today. I'll start sharing a screen. But before I start sharing a screen, I think it's important for listeners to understand one thing. It is very dangerous to jump to suburbs right away before we actually understand our brief, our purchasing strategy, etc. So essentially, you need to know where you want to be, deconstruct that all the way back to the individual purchase, and then that information shapes the research algorithm, which is a collection of filters, which delineates the shortlist and the suburbs and moving forward. So you can't sever that link. That's extremely important, which is why I always say a hotspot for you is not a hotspot for me. We all have different financial circumstances, which inform the significance of different metrics. Okay.
Yes.
So with that stated, what I'll do a quick, we said, Adam, what is it, 5 to 700 price point?
Yep, we're going to go 500 to 700,000 price point. We're going to pick some boom suburbs, and maybe you can pick some failing suburbs. Just on that as well, one thing I should have mentioned, we're going to put a discount link at the bottom of this video in the comment section or wherever it goes. So there's going to be a discount link to join up. But just one thing to remember, and Matt said it as well, is just because we can give you the golden goose, which is, this data platform, it's still the user that determines the outcome. It's like having a fast car and having a 5-year-old drive it versus having a race car driver. You're going to get very different results from the same fast car, and it's no different with this. So just keep that in mind. And by the way, this is not financial advice, and you'll see all the disclaimers and all that stuff. Don't go and buy a property after looking at this video. You need to do your own homework, due diligence, and I recommend to do my course because it goes through the whole stages from setting up the structuring, financing, working out what your strategy is, all the way through to buying properties and selecting an individual property. You're not buying the whole suburb, so your individual property is not going to perform the same as the suburb. So you can perform better than that, and that's what my students are doing. Or if you aren't educated, chances are you're probably going to be performing worse than the suburb. So just bear that in mind. So Matt, I'll hand over to you.
Yeah, no worries, man. And that's, I guess, one thing before I start, what you pointed out here is a crucial bit in property investing is minimizing opportunity cost. And what is opportunity cost? Opportunity cost is the cost of buying in an inferior location or an inferior asset, which means that it lowers your long-term averages, which means that it reduces your capacity to create wealth. Now, as I always, like I said this before, it's one thing to have figures on a page, you have to connect them into a story, and this is the user reference that you've made. We need to understand what are the drivers of growth, what produces growth. We first need to understand our brief. Then we need to understand what are our goals, both short-term, mid-term, and long-term, which will then inform which metrics have a significance. So I usually say to our users, the first 4 questions that you have to answer before you use the platform is, what is your budget? What is your investment time horizon? When do you plan to extract equity into the subsequent purchase? And what is your risk profile? because these 4 questions will drive the construction of the research algorithm, because you'll have a completely different set of suburbs if your investment time horizon is 3 years as opposed to being 15 years. Also, you have a completely different set of suburbs if your equity extraction time frame is 2 years as opposed to 7. Why? Because 2 years you need to invest in a hotspot. If it's 7 years, you can purchase in a warm spot, an area that sort of exists before that warm spot territory, sit on the sidelines, etc., etc. So as I said, like, you have to first develop that brief, and then that brief informs your research algorithm. Now, what I usually do when we do a lot of coaching, as attached to the HTAG platform, we also have Mastermind, which is essentially the coaching community. And this is where we teach how to slice and dice the database in a particular way to completely eliminate opportunity cost. Now, for those who have not used the platform, there's a lot of housekeeping that we could do, but just because conscious of time, you can look at the housekeeping elements in my videos that I do on the Mastermind platform. But pertinent to the discussion, if you scroll below and you look at strategies, we have a pre-filtered strategy area. And this is essentially 9 different strategies which answer those 4 questions in 9 different ways. So if you see, we have 150 to 550K, long-term investment time horizon, low risk, equity extraction time frame, 2 years, hotspot. Now, what is important to understand? It's important to understand the cycles of suburbs. So usually warm spots last anywhere between 1 to 4 years, and warm spot is best characterized as a suburb that is generating anywhere between -5 to +5% growth. Hotspots are usually suburbs that are generating +10% growth. Okay, so when you're answering those 4 questions, you're layering those answers in a way where it sort of pinpoints the locations where you can invest. You can't invest anywhere under your brief, and this is what research is. The research is a funnel-like approach where you start from the entire database in your brief, and then you pinpoint the best suburb. Now, what Adam has asked me to do is to look at suburbs that are between 5 to 800K or 700K. Now,
we want the booming ones. We want to make bank in the next 6 to 12 months, 2 years.
Okay, that means we want a hotspot. So equity extraction time frame is going to be
which most people just want to make money quickly and do nothing for it, right? And
correct. They want to leverage the market
momentum.
We all? They want to leverage market momentum. But there's one thing, before we go into that, there's one thing that I'd like to, as a caveat. Now, hotspots are all good and well, but we must know that entering a hotspot, there are a couple of disadvantages of entering a hotspot. First, it becomes very hard to find that particular asset that you want. And you did mention not every asset in a suburb will grow. So sourcing that best asset can be difficult because you're competing against many other buyers agents, and some of the buyers agents out there have leverage and they purchase 100 homes a month within a particular suburb. That means that they have better relationship with sales agents and everything else, and the sales agents are answering their phone calls first. So that's one thing to understand. The second thing to understand is that you'll be overpaying for that asset. Now, your brief,
or at least paying the list price just to get it.
Well, I mean, that's what the definition of a hotspot is. Hotspot means that the asset is growing in value, which means that it's a seller's market. It's not a buyer's market.
Correct.
Which means that the seller is dictating the price, which means that inadvertently implies that you potentially might be overpaying for an asset. Now, that's all good and well. If you have the capacity to extract equity within the first 1 or 2 years because of your serviceability, you need a hotspot, and it's fine. You just need to play the game. But you need to understand that there are some negative hallmarks of a hotspot. Now, going to the strategy. So, Adam, your suggestion is to pick 550 to 850K, long-term, low-risk equity extraction timeframe, 2 years hotspot, yeah?
Yep, let's do it.
So when you click on that, what happens is you get a pre-populated research algorithm. Now, I always say to everyone, you need to understand why every line has been inserted. Not only that, you need to understand how every line is connected to the next metric and why it is there. Now, in the filtering process, we want to eliminate noise, meaning that we don't want to place too rigid of requirements on our database because we might not get any results. So this means that we have to address those crucial aspects, address them and connect them all together, leaving the rest for the final comparison. Now, so I'm not too abstract. I want to explain what that means. Now, in HTAG, we have 2 domains that we want to analyze: macro narratives and micro narratives. What are micro narratives? Micro narratives are as close to the purchase point as possible, i.e. reflected in the supply and demand trends within a particular suburb. Macro narratives are those narratives that need to be present for a particular price point. They are risk, affordability index, and socioeconomics, especially for a price point that's between 550 to 850K. Now, I'll go into each one quickly, just because it's important for listeners to understand why they matter. For example, the first one is, I didn't mention confidence. You need to make sure that there's a high confidence of data within a particular area, which equates to volume. If you're purchasing in a suburb where there's one purchase this month and then another purchase in the next 3 months, one was sold for 550, the second one was sold for 850, what is the typical price of that suburb? You can't average the two because you don't have a sufficient volume in the data set to determine pattern. And the same goes with every other metric that's derived from a sale, such as days on market, etc. Let's say one was sold for a days on market of 25 days, the other one for 150. There's not sufficient volume for you to determine pattern. And now if your investment time horizon is long-term, you need to be looking at a data set that it has high accuracy, because the longer you go into the future, the more uncertainty you bring upon yourself. And data sets that are medium and low confidence have high oscillations between month and quarters, which means that you might be buying in a suburb that today has 25 days on market and the next month release in the next quarter has 125 days. And you're just surprised and you're going, oh, wow, I didn't invest in this suburb. This is not what I wanted. So you need stability. Stability equals volume. Volume equals a discernible pattern upon which you can make a decision. So data confidence is essential. Risk is another factor that we have on HTAG. And the way we determine risk, there are various ways to determine risk. The way we determine risk in HTAG is, okay, what is going to stop me from realizing my goals? In this instance, we want to realize growth both short-term and long-term. What are the factors that are going to impede on my ability to generate those above average returns long-term and to extract equity within the next 2 years? That's industry, high industry centralizations, dominance of mining and agriculture, exposure to bushfire and flooding, etc. And there are many other metrics that form part of our risk score, but these are the 4 dominant ones. 2 are economic, 2 are environmental. Now, we do see that towns that have very highly centralized industries might experience a pump, if you will, if I'm going to use a crypto term, but in the long term, they can see enormous negative return. For example, Newman has one of the highest average wages in Australia, one of the highest employment rates in Australia, and yet its price has seen minus 50% negative growth in 10 years because the industry can be adversely impacted by macroeconomic changes. Let's say China imposes tariffs on coal or whatever it is. Yep. The coal mine or whatever gas mines starts laying off workforce. The purchasing power of residents diminishes, especially owner occupiers, which is 2 times larger purchasing cohort than investors, and you see a price decline. Yep. So
same as Perth.
Sorry?
I said it's the same as Perth, basically.
Absolutely. And this is why I always had issues with Perth. This is why I always had issues with Perth, because some of the areas, Perth is a big market. Now you're generalizing now. But
we won't go into too much detail. I won't go off topic too much, but I just thought I'd throw that one in there to get a couple of people revved up. And we were having
it's a good one. It's a good one to rev them up. Anyway, you need to account for risk to buy an insurance policy to minimize the long-term volatility and price stagnation in an asset or in a suburb. Affordability, macro factor. There is today we currently live at the time where there's the highest disparity between median wage growth and property price growth. There's a huge gap, and this adversely impacts the capacity of owner occupiers to purchase property. So in order for your suburb to turn into that hotspot or to be that hotspot for extended periods of time, you need higher levels of owner occupier activity participating in the market. They're 2 times larger lending group than investors. So you need to make sure that the market you're investing in contains affordable property for the owner occupier cohort. Again, a macro aspect that must be satisfied before anything else. And then we move on to socioeconomics. There is 0.35% chance for a 650K asset to double in value in a decade with an ERSAD of 1 or 2, or disadvantageous socioeconomics. We have a socioeconomic score called ERSAD, which is a range between 1 to 10. 1 and 2 are disadvantageous, 2 to 7 are neutral, above 7 to 10 are opportunistic. You can see in the strategy section, it is divided per price points, because the price point drives the significance of indicators that we have to consider. So between 550 to 850, we have to eliminate suburbs that have disadvantageous socioeconomics because there's minimal chance they're going to double in value. The next question that you might have is census is every 5 years. Now, which means that data is old. The answer to that is we have on our platform a complete data set of URSAT changes since it's been recorded. And what usually happens, and URSAT is usually linked, or some attempt to link it to gentrification, saying, okay, Matt, within the 4 years, what if the suburb gentrifies? Well, first and foremost, gentrification happens in long time spans. Okay, so you can't have a gentrified suburb or completely replaced economic underpinning of a suburb within a short-term time frame, which is 4 or 5 years. Short to mid-term. I would classify that.
For those people that don't know, like gentrification, or I term them suburbs in transition, are ones where there might be a whole new estate that pops up that's got 1,000 lots in it, and it basically makes this old sleepy suburb into a new one with new houses and properties, and it's heavily driven by developers. And it can go one of two ways. Depending on the stock that's being provided by the developer, it can either be, if it's housing commission, it's going to pull the suburb values down. And if it's luxury or more luxury homes or smaller blocks of land, and if you live close to a capital city, you'll know what I'm talking about, half the size blocks of land at the same price by a major developer. And as I was saying to Matt just before, I'm in an area where a major developer just decided overnight to put prices up on their land estate by 20%. So that's a suburb in gentrification, or what I term as transition, where it goes from old houses to new ones, or vice versa. Similarly, they might get demolished and the blocks split with new houses, or there might be massive renovations, or they might be knocking over low density, so single houses, and putting high-rise towers there. So all of those.
Would you say, and I believe that it also needs to be supported by the demographic changes. Now, when I say demographic, I don't mean the age of the population, but the purchasing power of the population.
Correct.
Because a developer might increase the pricing by 20%, but there needs to be someone who's able to buy that at the same time. So essentially, the entire GDP, gross domestic product, if you will, of the suburb completely shifts and changes when one suburb transitions from a non-gentrified to a gentrified suburb, you know? So there is a lot of elements there. So, and that takes years. And also, if what we published on our website, which is essentially ABS data, which we tabulate in an Excel spreadsheet, you have access to all of the changes that have happened in URSAT across years. And usually what is interesting is the gentrification happens at either ends of the scale. So gentrification usually happens at the lowest end of the socioeconomics or at the higher end of the socioeconomics. However, the jumps are not dramatic. You don't see a jump from an URSAT of 1 to 5. You see a jump from an URSAT from 1 to 2, then to 2 to 3 maybe. And then at the other end of the spectrum, you see a jump between 8 to 9. So the changes are not dramatic and they take a long period of time. That's one thing to really remember, which makes the socioeconomic score by ABS contextual and relevant in this instance. So again, because the price point is to 850, we eliminated all of the negative or disadvantageous socioeconomics. And then we go into the micro elements. What are the micro elements? Again, as close to the purchasing point as possible, which is the HTAG, is the suburb level. We restrict the supply. Now, I usually get a question, why do you go to supply first? Why don't you go to demand? Well, the answer is very simple. First, I don't control the supply. I can control the demand. There's 1,000 members on HTAG. I say, go buy in this suburb. They go buy, demand is controlled. And you can
artificial demand.
Yeah, you can see that happening, you know, big buyers, agency houses, et cetera, they have the capacity to control the demand side of the equation. And it's all good and well. It's not, I wouldn't say it's a negative term, but when I'm researching, I first address aspects that I cannot control. Then I deal with aspects that I can control, which is why we then restrict the supply. Now, it is very important to restrict the supply across all of the temporal domains, past, present, and future. Okay, to make sure that it's restricted throughout our asset hold period time frame. So stock on market represents current levels, let's say monthly, represent current supply. Inventory is essentially average months of supply, which has a historical element to it. Building approval ratio is a future supply of new dwellings in the next 2 years, let's say 1 to 3 years it takes for building approval materials into a dwelling.
If that.
Yeah.
If it's low density, it won't be that long.
Yeah, so that's why I say a range between 1 to 3 and average at a 2. Now, hold periods is also a supply metric, but it's a supply metric of existing dwellings far into the future. because we usually see on average people holding, you know, anywhere between 5 to 15 years in all of the suburbs in Australia. So we are restricting it now. We are making sure that it's been restricted in the past, and we're making sure that it's restricted in the near and far future. More importantly, there's a hierarchy of supply metrics. Long-term trends are more forceful than short-term trends. Short-term trends are more forceful than current values. Why? Because property is an illiquid asset. It doesn't exchange hands on a regular basis, such as crypto and shares, which means for a reversal to trend or in a long-term established trend to occur, it will take years, which means that the long-term established trends are a great way to predict what is going to happen in the future. Meaning, if you have a nosediving stock on market and nosediving inventory, depending on the angle of the nosedive, the more nosediving it is, the better. You can interpolate that that's going to continue 3 years into the future. So that's how you restrict. You're restricted by time domains and then by trend. And that's why we have stock on market long-term slope. We set it at less than 0, which means less than equilibrium. So it's nosediving. Now, some of you might ask, why don't you forcefully nosedive it? Well, my job is to cast a wider net initially to make sure, because you don't have a perfect data set. A perfect data set doesn't exist, which means you might exclude a phenomenal area simply because you were too restrictive on a particular metric. So you need to work within those favorable boundaries, and then you actually go into detail and you funnel it down. So we have stock on market long-term slope, stock on market current values. Inventory long-term slope, again, needs to be reducing or nosediving, less than an equilibrium line. Building approval ratio, I set it at less than 1.5%. My preference is to be less than 1%, in all honesty. But I set it at less than 1.5. Again, I'm a little bit casting a wider net, but I'm not setting it at 3% because then this metric becomes meaningless. You know, so I need to know that sweet spot of opportunistic and neutral ranges, which you have in our data dictionary, by the way. And that's how I work and lay out the metrics. And then when it comes to hold periods, we want a hotspot, but our brief, let's assume, suggests that we're going to hold the asset for 10 years or more long term. So we want to restrict the hold periods. Now, I set it at 7, which is bottom end of one property cycle in general, if you want to, you know, 7 to 10 years. It's a bottom end. Yeah. Now, why don't I set it at 12 if I want to completely eliminate future supply, if I'm going to hold the asset 10 years? Well, because there's not enough areas in Australia that have a 12-year average hold period. And again, perfection doesn't exist. So I might exclude some rippers, if you will, that have a 10-year hold period, you know? So I set it at 7, bottom end, cast a wider net. Now, the next thing that I do, I delineate the market cycle position. So I don't go into demand, and I'll tell you why, because we're using DEX, and I'll show what DEX means. I delineate the market cycle position after I've set everything that relates to my brief. So this algorithm relates to my brief. We have affordability, URSAD, restricted supply. Then I want to say, okay, I want an area to be within a particular position of a cycle, which means hotspot, because we want to extract that money in the next 1 to 2 years, purchase another asset. So the best way to delineate market position is to look at last year growth. Anything that has seen above 10% average growth in the last year is within the hotspot territory. And this corresponds to on-the-ground activity. If you go to a market, to an open house, that has seen 10% growth in the last year, I can guarantee you're going to be one of the 35 to 40 bidders. Okay. So that's why you know already it's a hotspot. So I delineate the market cycle. I say price change in the last year, I want it to be greater than 10%. I'm now eliminated noise. We have 38 entries. So we have 38 entries now.
So just scroll up. So before you jump into the actual suburbs, and I know people may fast forward through the boring parts of you explaining all the little bits and pieces. But I think if people can understand the fundamentals behind why you're doing what you're doing and get to that point where if you understand the fundamentals, you can understand why property values change. But just to recap, just to keep it really simple, my philosophy that I was taught by a property valuer is property increases in price from 2 main reasons. One is the supply, which is exactly what you harped on about at the end. So restricted supply, and the other one, which is a big part of your equation, is capacity to pay, which is ultimately the affordability. So it's all well and good that a developer can put up prices by 20%, but if people don't have the capacity to pay, they just physically can't buy that property. So that's it, just to keep it really simple. And there's other stuff that goes into it. But ultimately, if you think about it like that, so you've only got two parts. You've got restricted supply and capacity to pay.
Absolutely.
And different parts of the country have gone through different cycles where they've boomed, and then it gets to a point where there may be restricted supply, but people physically can't afford it. And a lot of parts of Sydney have gone through that at various different times that I've seen over the last 15 years. And now with, and I won't go into it too much around where people are migrating from, and that baby boomers have a lot of money. So that aging demographic that is cashed up, that might be selling their house in Sydney, buying in Queensland, or East Coast buyers buying over in Perth. There's, again, those two formulas, like just high level. There's capacity to pay, and there's restricted supply, and people are getting into that hot market. So just on those particular aspects, I completely agree with Matt, and Matt's the expert, not me, in this field. I've just transacted a lot of properties, and I've seen this play out in real life. A lot less around the numbers. I'm sure Matt's looked at thousands of different areas, more than what I have over the years in terms of the number demographics. But I reckon I've looked at least a few thousand properties and monitored the market for the last 15 years. That's literally what I've been doing, basically 80 to 100 hours a week for 15 years. So just on the last point, just to keep moving, the price change, why do you want to set that at 1 year? Why not set it at 6 months to try and get into that booming suburb earlier than after a year? Because
well, that's not our brief. Our brief is we want to extract equity in the next 1 to 2 years, which means you already want a rampant hotspot. Now, you buy an asset now, you wait 1 year, you generate 10%. You wait another year, that's 20. Then you extract equity. Okay. If you want to delineate a suburb prior to it becoming a hotspot, then you want a suburb that's transitioning between a hot and a warm spot and a hot spot. Then the algorithm changes. So our brief stipulates that we want to make as much money as we can in the next 2 years. So our brief is not anticipation. Our brief is very clear they want to enter a hotspot. And arbitrary figure of 10%, it's not arbitrary, but it's arbitrary on face value when we're doing it. Again, it corresponds to the behavior on the ground. And I'm saying greater than 10%. So that includes the 15s, the 20s, and the 30s. Yeah. So for us to extract equity within the first, and I think you said 1 year, which means that we need something that's has phenomenal market momentum. I said 2 years, it's much better because you allow for a bit of compounding. We need a warm spot. Simple as that. Now, that's why question number 3 in your brief construction process, when do you plan to extract equity in the subsequent purchase, allows you to delineate the market cycles that you need to enter within.
Okay. Do you have a formula for the other way? Markets going down? Okay.
Absolutely.
All right. So do I. It'd just be interesting.
Yeah. So
let's have a look at the suburbs that come up.
There are 9 different formulas, Adam. And they all have different arrangement of metrics. Now,
you must have only just added these in. I haven't seen these. Is this added to everyone's?
No, this has been in for a while.
Oh, there you go. I haven't looked. I've got my own.
Yeah. So what do we have? We have heaps of markets here. Now, guys, before I move into markets, one thing that I want to add, Adam has actually pinpointed that every data point is a representation of behavior. Now, analyzing data and understanding which suburbs will boom or where to invest is actually very simple. If you really think about it, if you use common sense, if you have the ability to purchase and to buy, and you have supply scarcity established, that is a perfect storm for price growth. Just think about it. Now, let's say, as I always use, bake cupcakes. I have 1 cupcake, there's 10 bidders for the cupcake, I'll increase the price. Simple as that. If I have the ability to pay it as well, just reduce it down to common sense and behavior on the ground in your everyday life. You go to Coles, you buy things, these purchasing patterns and behavioral economics essentially transpire across every domain of our life, not just property.
Absolutely.
So if you really
remember when the cyclones all wiped out all the banana crops and bananas went to $15 a kilo?
Correct. Supply scarcity. And you had the ability to purchase. Everyone can purchase a banana. So it's simple as that. Now, what I do not have bias. I don't care what the suburb names are. Remember, I'm constructing an algorithm that relates to my brief. I want to buy.
Most people do. They're like, oh, that suburb's a shithole.
I do not have bias. I don't care what the suburb names are. I'm constructing an algorithm that relates to my brief. I want to buy.
Most people do.
A lot of information floating out online. We have to
Yeah.
understand how we're psychologically influenced to make decisions, and developing a research methodology and thesis and moves the emotion out of the process. If you're an investor, you're a rational decision maker. You're not an emotional decision maker. If you're an
And also,
owner,
you're not living there. You make sure you don't buy a house that's going to get, lit on fire, or, there's cars out the front with wheels missing. I personally wouldn't buy an investment like that because it'll be a headache. But it doesn't mean that suburb doesn't do 100% growth in the next 2 years.
There are a plethora of suburbs that are 450K or 500 in value, which have an ERSAT score of 1, meaning severely disadvantaged socioeconomics that have seen 100% growth in a decade.
Yep.
This is why the socioeconomics don't play much of a bigger role at the lower price end as they do at the higher, but absolutely.
Agreed.
Now, it is a rational decision. Will I make money from this purchase? Now,
all right, give us the suburbs. And I saw a few of them come up and I already know.
Yeah, but see, I don't even, we can look at these suburbs and I'll pause here, but I don't look at the suburbs at this stage because there's another process that we have to go through to actually find the best one. And we'll get to that. But for listeners, they can look. We have Athen Grove. We have, what are the usual culprits? Mount Louisa, Mount Sheridan.
The one on top, I actually went to school in it, Ender Grove.
Oh, really?
School? Yep.
Yeah.
No,
so that one is in Mackay. Now, again,
Armadale.
Yeah, you can go Annandale, which is in Townsville.
And I saw a couple of Rockhampton ones.
Yeah, so you have
another place I lived for nearly a decade.
You got Rockhampton, Townsville, and Cairns.
Yeah,
that's why you don't have the you don't have the Victoria areas because of Victoria is still not in a hotspot territory. No, so that tells me that the research algorithm is completely correct. So you see some of the SA areas one-offs, which are interesting, but you see a couple of WAs, which is again given a normal because WA is coming off its peak, but it's still in a hotspot territory
for a bit longer.
You see, so all the usual suspects are there. Suspects are there. Now, as I said, I don't care. I don't look at the names. I don't care about the names. I still have to do a detailed comparison. How many do we have? We have 38 entries. Which one will be the suburb with lowest opportunity cost for my brief? Is the next question that I have to ask. Now, we have an expert view of the table, and Adam has alluded to this in the beginning. I think we have by far the most amount of metrics in market. We have about 100 now, and triangulation with us is the most important aspect of comparison. You need to look at the same area from many different angles. Now, it can get a bit complex if you just look at this table, and let's say you scroll across and you go, wow, all of the metrics are color-coded, meaning opportunistic, neutral, or unfavorable, etc. There's a lot of information here, but this is not where you do the comparison, because first it's overwhelming. You can't compare all of the suburbs across all of the domains by just looking at the actual table, and this is why you need to use DEX. Now, I'm not sure, Adam, how much experience you've had with DEX, but DEX is a really groundbreaking module which allows you to compare 6,000 suburbs across 100 metrics in 5 minutes. So that's where the key thing is. And this is why it really eliminates opportunity costs and forces you to find that best asset for your brief. Now, if you click on DEX, which is below here, we have DEX Lite and DEX Pro. DEX Pro has all of the 100 metrics. Now, in our mastermind, we teach how to do this. There's a play button which explains the metric, its significance, and how you set the multipliers, etc. Let me just do a quick, so we don't
let's just keep it high level for now.
High level.
Yeah.
DEX separates all of the metrics in a hierarchy. Some metrics are more significant than others. And to give you a simple example, if you're after a cash flow strategy, yield and vacancy rate is going to be much more significant than days on market and stock on market. Not much more, but more. Yeah. Now, if you're after a purely growth domain, what's your primary domain? If it's growth, then vacancy rate take a backseat and yield. Okay. Now you have a balance strategy, which is a balance between the two. And essentially you are assigning weightings or significances to every metric in response to what you're looking at. Okay. Now we have at the bottom a cheat sheet. The hierarchy is level 1, level 2, and level 3, level 1 being the most significant. And then we also have a timestamp associated with it, which is why, if you recall back, the brief that I've asked has multi-dimensional temporal domain, i.e. has a long-term aspect, has a short-term aspect. So if you have a long-term, mid-term, and short-term aspect in your brief, that means you need to refer to ST, MT, and LT metrics, especially those that are level 1 and level 2, and assign higher weightings to those to get what you want.
Yeah.
And
So let's just say, just because I know this is where most people are at, they need high income, so high yield, and they just want to be out of there in a couple of years. And just for those people that are buying regional, especially, my view is regional markets are ones that you get in and get out of, and you don't hang around in that space for a decade, because I've been in that space. The market comes off. I've witnessed it with other people. They end up getting stuck there. So my view is, if you're going to go regional, be prepared to sell it in a period of time. And this is what the strategy does. You're not in there for 10 or 15 years. Generally, not always. I'm sure there's ones that have bucked the trend. But so if we just were to pick the top ones in that aspect, so give me high yield and ones I'm going to exit in a couple of years, either pull the equity out or sell the asset and then pump that money into something else.
There's a bit of a contradiction there. You want high yield, but you want a hotspot. Now, by wanting a hotspot, you want an area that is growing, where price is growing at a faster pace than rent growth. So in your comparison, what you're doing, you're pulling the database in two opposite directions, because you're telling it at one end, I want a growth area, and at another end, I want a high yield. And in doing that, you're averaging the results out, increasing opportunity cost. So decide what we need to decide.
So the yield will just be like the purchase yield. Don't worry about the future growth of the yield. Totally. Yeah, so it's yield right now. So we know we can afford to buy the property, or that gets counted towards our loan. So let's just say we need a yield of 5-6%. That's what most people are chasing to cover the mortgage costs. But
you're not going to get a yield of 5 and 6% in this list, because you want a hotspot.
On average, what's the best? I mean, you've got 38 suburbs. How would you? And I have my own way of doing this, but one easy way would be filter by highest yield. And I know what you're saying about opportunity costs and that, but
yeah, okay, I get it. So let's look at the yield.
For most people, it's like getting a property in a hotspot and being able to afford to hold or to get into it, for starters, unless you're getting into a really cheap market.
Yeah, but see, I understand, but there's an educational element here that has to happen. Now, individuals must understand that growth and yield work in inverse manners.
Yeah, so in other words, as the growth goes up, yield compresses, goes down. Yeah, I lost you, Matt.
With heights, So in this list,
hang on. I lost you there for a sec. It might have been my end. Yep, it is my end. Hang on, it'll come back on. That's what Starlink does when you're out in the bush. It cuts out every so often for 20 seconds.
You got Starlink?
Yeah, it's pretty good. It's actually better than NBN, but every so often it just drops.
Yeah, so what I was saying that, there's an educational piece that needs to occur for clients. Now, we have to be very certain about what we actually want. We can't have our cake and eat it too. Now, if you want to maximize growth momentum within the next 2 years, then yield is going to take a back seat. Even the primary purchase yield, even the purchase yield now. Now, in this list, you said 5 to 6. There is only Edmonton with 5, and the rest we can see 3.5, 4.61, 4.7. Essentially it's between 3.8 gross, not net.
What's the highest yield in that list if you just sorted by highest?
It is Edmonton.
That's in Cairns, isn't it?
Yes.
There you go. Yeah, keep in mind that is the average, or however you guys do it. And I know suburbs that I've bought in or clients have bought in, it'll bring up the yield at 3.5 or 4%. But one particular property, we can do 5 and 6%. So just because it's got 4% doesn't mean that it is. As in, it doesn't mean that the property you're buying is 4%. There's plenty of 5-6% yielding properties in those areas. If you know which properties to pick. So that's what the data can't do for you.
This is an aggregated view on the suburb.
Yeah.
Now, when you go to purchasing, you will be choosing assets which have variations. Now, because it's aggregated, you're not going to see 30% variations. but you will find those that have better yields than others,
Yeah,
Um,
absolutely.
now it's Edmonton. Now going to Dex, you can all good and well. Now I usually go this in my coaching sessions and I explain every metric and every multiplier and why it's there. Now, let's say we do want to be particularly very important and like we're very particular on yield. It's a level 2 metric, which means that it has a multiplier between 4 and a 7. We'll give it a higher multiplier. Now, the multipliers, essentially a correlation analysis we've done that correlates to an outcome that you're producing, whether it's capital growth or cash flow. This is how we layered the metrics in terms of a hierarchy and significance. Rental increases, we don't care about it because you mentioned, I'll take it out because I don't want to pollute the database.
Agreed.
Now, I do want to assess the suburbs from multiple angles, but the more unnecessary angles I introduce, unnecessary is the term, the more I pollute the database and average the results. So we need to exactly know what we're looking for. Now, GRC.
In other words, just to sum that up, it's basically just focusing on a couple of key things that you want and not trying to tweak every metric, because the more you tweak it, the more complex it becomes. And you could be ruling out really good suburbs just because you want rent growth, but that rent growth may not be there. Your rent might stay the same for the next 2 years, but the property does 100% growth.
Exactly. So you might have a great yield now, but not a lot of prospects for rent growth because remember, it's a hotspot. So the price is booming.
Yeah, your rent sets the price.
So why would you average your results by assigning higher significance to rent? Because that's not the outcome that you're after, So absolutely. GRC index and GRC minima for the listeners, I can go into, I love to talk 2-hour narrative of what these metrics are. Essentially,
keep it high level.
They're long-term stability metrics. GRC index, how many months has the area spent above the zero line in the positive growth zone since 2007? So it takes the shape of the GRC of growth rate cycle and calculates, the stability and endurance of the area. GRC minima, okay, what's the bottom end of the growth that the area has experienced, which is a proxy for volatility. Yeah. If we're investing long-term, let's say hypothetically, we do want to extract equity in the next 2 years, but we also want it long-term, which means that we want to do another equity extraction under this asset, we need to have this stability and endurance indicator. So I'll give it a 7. It's a level 2 metric. URSAD, socioeconomics, very important for this price point. I give it a 10. Now, just for listeners, I'm assigning weightings. Think about this as weightings. I'm assigning weightings to metrics which nuances suburbs that have performance in domains that I want them to have. Okay. And these domains are very particular for the brief that I have, which is short-term equity extraction, long-term investment time horizon. Renter to owner ratio, and again, I can do a full lesson about it. Renter to owner ratio, I'll leave it a 7 out of a 10. Affordability index, C, leave it a 10. Again, it coincides with what we said before. You need to have the ability to purchase, which means that those areas that have a very low affordability index are going to be pushed to the forefront of our list, and they're going to have a highest multiplier, which means that the end total will be higher, pushing those at the front. Does that make sense, Adam?
No, just say that again. So
the multipliers is a weighting factor that's assigned to a metric.
So that bit makes sense. But when you were talking about the affordability index, what were you referring to there?
See how it said it reverse?
Yep.
Reverse, which means the lower the affordability, the higher it should be on the short list.
Yeah. So in other words, the lower the affordability number.
The higher the affordability. That's right.
Yeah.
So if the index is 30, we have one affordability index of 30 and another one of 40. That one, which is 30, will be pushed to the forefront of the list. Furthermore, it attracts even a higher multiplier of 10, which further compounds it being at the front of the list.
Yeah, agreed. Yeah.
Yeah.
In other words, we want really affordable areas.
Correct. Now,
which means that they've got a long way for potential.
Absolutely. Now we go into supply. They're all level 1 metrics, especially for us because, we want the equity extraction in the first 2 years. Now, long-term slopes are more forceful than short-term slopes, which are more forceful than current values when it comes to prediction. But let's say we want to establish severe supply scarcity. I can assign even a short-term slope with a 10 multiplier, i.e. a higher significance, just to make sure that scarcity is there. And we do that for an inventory, let's say short-term slope as well, and long-term slope, we'll keep it at a 10. Hold periods, how important, and this is what I say to every user and when I coach, you need to go through every metric and ask yourself, what is the behavior that this manifests and how is this important for my brief? Okay, if we want to extract equity in the next 2 years, we establish the supply scarcity with using trends in stock and market and inventory. Now we got to hold periods. Are we going to hold it 10 years? Let's say yes, we will. Then hold periods are important. Okay, we'll keep it at an 8, meaning that those multiply of 8, meaning those that have higher hold periods are pushed to the forefront of the list. You know, you have hold periods, long-term slope and short-term slopes. You know, you can keep them.
We got to be coming to the end, right?
Yeah. So that's doing me.
We don't want to
this way.
We don't want to overcomplicate it just yet.
How long is a piece of string? You know. Now I can plow through this quickly. Let's assign higher weightings to the demand side. Okay. Now vacancy rate. You tell me now, Adam. This is a question for you. We assign a higher significance to yield, but do we care about the vacancy rate slopes? And before you answer, vacancy rate slopes, if it's a nosediving slope, it has an effect on increase on rent, which increases the yield.
We only really care about right now getting cash in the door so we can get the loan, as in high yield right now. And in 2 years' time, we're going to either sell the property or refinance it, but we'll work that out in 2 years. But if we're going to be regional, I would say, if it was me personally, I would take the money and run, cop the tax hit on it, and pump that money into, I like longer term, I shouldn't say longer term, I like capital city locations, especially on the East Coast, because they're more stable long term. And there's always going to be a demand in most areas, not all. I am painting a generalized brush here, but there's always that demand and the capacity to pay is higher because the wages are higher closer to the city. Generally speaking, obviously there's exceptions to that.
Yeah, just so you know, though, caveat, the research algorithm we had was a long-term buy and hold equity extraction time.
Yeah, you did say that. Yeah.
So it was a bit of a different story there, but it doesn't matter.
Doesn't matter either way.
Anyway, you'll go through all of it.
Take the money in 2 years or leave it sit there for 10.
Yeah. Essentially, there's a cheat sheet at the bottom which allows you to gives you the multipliers that you assign and the time frame associated with the timestamp. When you assign all of the multipliers of the significances, you essentially click on export and it generates, let's say, generates a data set. Let me just pull it up and generates a normalized data set. What that means is that it takes into account all of the weightings, all of the multipliers and the ranking and all of that, and does essentially an equation, mathematical equation, which produces a top score. We can see that the one with the highest score is the best particular option for this brief. Banksia Park,
South Park. Australia came up in the list. There you go.
First 3. You know why? Because we had the long-term components there. We didn't focus primarily on the short-term return. So I had the whole periods, GRC minima and GRC index there rated highly. But if I take that out, then potentially you would have the Mackays, the Townsvilles, and the Cairns there, you know?
Yeah. Which is the ones you get in and out of.
Correct.
Take the money off the table and run.
And this is what I always say to people. You know, let's say you generate the top 5 now, or top 6, or even top 10. Keep in mind, this is top 10 out of the entire Australian database. So you're still doing phenomenally. And when you're searching for that best asset, and this is your comment, Adam, you need to find that best asset. Don't just hunt for assets in the top area. You know, have your, you know, spread out. You know, even if you can buy a great asset in area number 5 and you can do better than buying in area number 1. But, absolutely. You know, you're sort of working with the first 10, and we have some great options in the first 10. We have Burdell, Mount Louisa, Rural View. There are some great options there. I would go for Burdell, you know, essentially, and it's coming at number 9. Now, why do I say Burdell? This is not my bias. I know that I've analyzed data sets a lot, and I do it daily for the last 7 years, as you commented, hours, thousands of hours. Yeah. So I know what the area looks like, and I know that if I assigned a high weighting to the short-term indicators, it will come out on top and SA will be moved down. But yeah, and this is how you come. And by the way, all of the areas are hyperlinked. So you can, let's say, click on it. It will take you to a suburb page, which is essentially Burdell. Now I have to log in because I logged. Let me just do it because I did it in incognito.
Where is Burdell?
It's Townsville.
Oh, okay.
Yeah. So here it is. So all of the areas that you see are hyperlinked. You can click on it. Essentially, you scroll down. You can take a look at the area.
Oh, okay. Yes, I know where that is.
Yeah. So
I know
this is a good one.
I know the
32%in the last year. that's a hotspot, man.
Yeah,
That's a
yeah.
rampant hotspot, you know? So yeah,
Yeah,
so
Bowl next door also had really high indicators that
yeah,
came up.
Bald Plains
Yeah.
was smashing it as well. And by the way, Bald Plains was one of the picks that I did for a buyer's agent who engaged me to find the next Perth. And I have emails. They engaged me in
I've
November.
got proof.
Yeah, yeah. I got proof. It's very important
I
because
have
I don't want
no
to be talking out of my ass. The
I have
engagement.
no doubt you would have picked that. That came
Yeah,
up in my list a while back, and it
yeah,
was
yeah.
in and Birddale now is probably experiencing the ripple effect that from the growth that Bowls had. It's just been pushed to the next suburb ultimately.
Yeah, and I mean, look at these, and now you know the usual argument, you know, vacant land equals oversupply. Well, Burdell has a lot of vacant land there, but look at this 32% growth in the last year, you know.
Yeah.
So
You know, who controls the vacant land? One or two developers?
well, there's a couple of degrees of separation between vacant land and an asset listed for sale. So that's the first thing. Also, to determine oversupply, we have to consider there's the demand side of the equation. So there's a lot of there, and I've written on this extensively. Now, I'm just saying that, let's say a lot of people who are in it for short term and they go, oh, vacant land equals oversupply. Well, you would have missed this one, and this one would have made you 32%, which is essentially Perth returns. Bold Plains has made 40% in the last year.
Yeah.
That's phenomenal. You know what I mean? So that's essentially the method of behind the madness. Brief, research algorithm, detailed comparison, assigning significance and weightings to metrics to accentuate those suburbs that really relate to our brief. And then we get a list, a short list, look in the top 5, look in the top 10, and you won't go wrong.
Yeah, awesome. So everyone listening, don't go out and buy a house in Birddale. You need to do your own due diligence.
Yeah, you all have different briefs. It's not, it's, you know, yeah, exactly.
So, but it looks pretty good according to your list.
Yeah, I mean, this was also one of the picks. 2023, I had a buyer's agent come up to me and say, Matt, what do I do? Do I ride the Perth wave? But I can see a cult kind of, you know, a Perth cult emerging. So I'm worried that it's going to be a pump and dump scheme, but I don't know where else to go. Should I just ride the wave? And he goes, you know, would you be able to do some research for me? And I did. And I had a list of 10 suburbs, Bold Plains, Burdell, Mount Louisa. Mount Louisa was number 1, I remember.
Yeah, don't give away all your secrets.
You know, that was 2023 in November, you know.
Yeah, a lot of those places are still doing okay, and they still got a bit longer to run.
Yeah, they're hotspots. They're hotspot, absolutely. And look at the affordability. Now, when you mention, you know, you need to have
look at that growth curve. It's huge.
Look at it, still below 30 years, man. Look at the growth curve that's been huge, but it's still very affordable for its residents. And yet, look at the nosedives in the day of the market. Look at the nosedives in supply. Severe supply scarcity, okay? Look at the rampant demand, 22 days on market, 3-month rolling averages. And both long-term slope and short-term slopes are reducing while the property is still very affordable for its residents. I mean, that's a perfect hotspot and one that's going to last another maybe 2 years for sure.
That vacancy rate is quite high. Why is that? Scroll down.
Vacancy rate, yeah, well, it's been increasing, and you know why this is a sign of potential investor oversaturation. Now the fact that it's, and that's why it didn't come up on your list, the top ones, the yields. Remember, now this is why I said we have to be very careful about our primary domain because we place higher onus on the yield. We pull the database in 2 different directions, which is why I say emerged. Now, if we took away the yield, then the Townsville and the Cairns and the, you know, those hotspots would actually come up as first. So the yield, the vacancy rate is high, but you know why? There's investor oversaturation in the market. And this is one of the indicators. Now, will this area grow more? Will this area grow more in value? It will, because you have a supply scarcity, affordability, and rampantly increasing demand. But when you're doing your calcs, allow for more than 2 weeks a year, at least before you rent it out first, or buy that asset that differentiates itself against all of the other assets, which becomes a bit difficult in a hotspot because you can't pick and choose. Now, there are many variants here, but I mean,
so you ultimately need some strategic advantage in these areas with higher vacancy rates, which I personally don't really like, unless if it's got a higher vacancy rate, what's the vacancy rate higher in? Like, what is that product? Is it a 2-bedroom unit? Is it a 3-bedroom unit? is there a demand for a 4-bedroom? And I'm not
demand
overly familiar with this.
Demand profile is 4 bedrooms highest. I mean, 3 bedrooms is also
Yeah,
sought after.
so that's when you actually need to start to look at listings on the ground and starting to talk to agents. What do people actually want? And maybe there's an oversaturation of cheap investor 4 bedrooms, because for my clients that are either in my program or investors jumping into deals or house and land packages, we upgrade, and I tell everyone to upgrade your house and land package. Obviously, it's area dependent, but if you got a flood of 4-bedroom that are all builders range tiles and taps, and you spend an extra 10 grand on the fit out, you can ask for an extra whatever, $10 a week, $20 a week. But it also means your house is going to get rented faster, because it's not the same as the other 10 that are on the market. It may be the same price.
Scarcity principle works with everything.
Absolutely. Yeah.
Now, if you turn
it's a unique product.
Yeah, if you turn your product into a scarce product, if you will, or product that's not dispersed out, you know, as much as all of the others, then, you know, it's a first pick. And again, you're right. When you're trying to pick, completely right. When you're trying to pick that asset, you might have to take into account a bit of additional outlay to renovate the property to make it a bit different than others. Just make it a bit different than others, and then your vacancy rate reduces, you know, allowance from from let's say 10 weeks to 2 weeks, which is standard, you know, when you're doing your calculations.
Yeah, cool. Awesome. Thanks so much for your market insights. Really
appreciate
it.
Mate. It was a pleasure. Thank you for inviting me, mate. It was great.
I'm sure everyone got heaps of value out of this. And as I mentioned before, we'll put a link to a discount code to higher than average growth in the comments or in the details section below. So check that out. You can have a bit of a play, see what suburbs come up. There's those preset formulas. I prefer to use my own based on my experience in the market and what I'm used to. So, but I mean, Matt's had 7 years of analyzing data. You've looked at more suburbs than I have, and had a look at those market trends over the last probably 70 years. I'm sure you've probably gone back into all of Australian
we have data
price history.
We have data spanning back to 1998, but it's presented on graphs all the way back to 2007, just because the curve becomes a bit sporadic thereafter. So it doesn't need to be.
I'm sure you've studied markets dating back to the early 1900s and market cycles, no doubt.
You pointed out one thing that's I always use I always layer the algorithm one by one. I don't use the pre-filtered strategy. Sorry, it matches the pre-filtered strategy, but I always like to insert metrics to make sure that I'm thinking about them. Because same as Google, you know, Google appears and we use it as an encyclopedia. We seem to remember less and less because we know that Google is there. In the same way, you know, when you're using pre-filtered strategies and you're not actually thinking about it, you get complacent. So I like to choose and insert metrics myself and ranges. Now they do match whatever is pre-filtered, but it makes me think about it. And that's always what I try to suggest to our members.
Yeah, agreed. All right, thank you so much. Really appreciate it, Matt. Hope everyone got a lot out of it. And any questions or anything for Matt or myself, let us know as well in the comments. Cheers.
Cheers, guys. Thank you.